This is the brief on Ecuador's SRI tax declaration forms. You might think tax forms are just an end-of-year headache for accountants, right? But Ecuador's Internal Revenue Service forms aren't just a compliance checkbox. They're the critical translation of corporate financials into tax language, where a single typo can cost a company its expense deductibility. First, the monthly VAT form drives cash flow at the 15% statutory rate. Output VAT from sales minus input VAT from purchases dictates what's payable. Think of collected VAT not as revenue, but a restricted trust fund temporarily in your bank. If your stationery company collects $3,000 in output VAT and pays $1,800 in input VAT, you better keep that remaining $1,200 liquid and ready for the government. Second, we shift from holding government money to holding your supplier's cash with the monthly withholding tax form. Corporations are forced withholding agents, keeping 1% to 10% for income tax and 30% to 100% for VAT. So what happens if you don't remit this short-term liability punctually? The SRI instantly blocks your passaported tributario, or tax clearance certificate, completely paralyzing your ability to win public procurement contracts. Finally, these habits culminate in the annual Form 101, digitizing your balance sheet. Remember the bankerization rule. Expenses over $1,000 must use a bank to be deductible. During tax reconciliation, non-deductible expenses get added back to accounting profit, taxed at the 25% corporate rate. So what's the actual cash penalty of a sloppy receipt? A Guayaquil transport company's $15,000 repair, without a valid e-invoice, gets added to their $100,000 profit. At 25%, that one undocumented vendor costs exactly $3,750 in hard cash. A company's financial survival in Ecuador relies entirely on the daily discipline of linking clean source documentation to final tax returns.